Hello everyone, today let us see what is meant by accounting concept or assumption. Now, first let us see what is meant by this accounting concept or assumption. In order to make the accounting language convey the same meaning to all people and to make it more meaningful, most of the accountants have agreed on a number of concepts which are usually followed for preparing the financial statements. Now, this you can say that they are rules that we have to follow or we follow while preparing our financial statements. These concepts provide a foundation for accounting process. Now, they form the basis or they form the foundation on which basis we compare our result with that of our competitors result and that of our past results. No enterprise can prepare its financial statements without considering these basic concepts or assumptions. Now, according to as per accounting standard issued by Institute of Chartered Accountants of India, there are three fundamental accounting concepts or assumptions. Now, these three are the most important concept that we use to follow. First one is going concern concept, then second consistency concept, and third is accrual concept. Apart from these three, there are other concepts also. All those things which we will read today we will discuss in detail. Now let us first start with first concept, that is going concern concept. Now when you start a business, usually you don't think that you will run the business for 1 or 2 years. No, we don't know for how long our business will continue or till how long our business will run successfully. So this concept is nothing but it assumes that the business is going to run for a long period of time. Then all the transactions and all we used to record it in our business in our books, keeping in mind that our business will be running for a particular period of time, for a long period of time, sorry. Now, as per this concept, it is assumed that business will continue to exist for a long period of time. The transactions are recorded in the books of the business on the assumption that it is a continuing enterprise. It is on this concept that we record fixed assets as their original cost and depreciation is charged on these assets without reference to their market value. Now, because of this going concern concept only, we used to divide our assets and liabilities into short-term, long-term, or current assets or fixed asset, current assets or fixed fixed asset. Based on this going concern concept, we divide our assets into fixed asset and current asset, and our liabilities into fixed liabilities and short current liabilities. And that is the reason why we depreciate our fixed assets every year, because we cannot keep or we cannot record the value of fixed assets every year as same as the amount at which we have purchased it. So that is the main thing that you have to understand about going concern concept. You don't have to go in deep, but you have to understand the meaning of each and every concept. So in this point, you have to only remember that while starting a business, you think that your business will be running for a long period of time, as this concept emphasizes on this concept's emphasis is on the fact that your business will be running for a long period of time. Now, another important point that you have to remember in this concept is that because of this going concern concept, outside parties, they enter into your business or enterprise for a long-term contracts, because if they think that if you don't think your own business is going to run for a long period of time, neither of the creditors nor your any money lenders will give you loan. They will not do business with you. Okay, then next is consistency concept. Now, this concept states that accounting principles and methods should remain consistent from one year to another. They should not be changed from year to year in order to enable the management to compare the profit and loss account and balance sheet of the different periods and draw important conclusions about the working of the enterprise. Now, let me take one example. Suppose your 1 year's examination result is given in percentage, and next year you got your result in grade system that you got A grade or B grade. Now will you be able to compare a percentage, your previous year's result with that of your current year's result? No, because one is in percentage and another is in grade system. So like that in business also, there should be consistency in the rules and concepts or the principles that you follow, because it will allow, if you are using the same principle rules every year, then based on those rules and principle, whatever financial statement you prepare, you will be able to compare it with other years financial statement, and that will give you an idea that how your business is doing, whether it is improving or whether it is declining. Okay, then but the consistency concept should not be taken to mean that it does not allow a firm to change the accounting methods according to the changed circumstances of the business. It is mentioned that you should follow same rules or same principles every year, but if something extraordinary happens, some circumstances forces you to change your principles, then at that time you can do, because we have learned that accounting principles are not flexible. Accounting principles are not rigid, they are flexible. You can change them, alter them based on your need or based on your circumstances. Then third one is accrual concept. Now in accrual concept, they mention that whether you have the transaction took place, whether you have received the money or not, but still you have to record it in your business statements. Okay, suppose, let us see. In accounting, accrual basis is used for recording of transactions. It provides more appropriate information about the performance of business enterprise as compared to cash basis. Now, cash basis states that suppose if you have made a sale, okay, if it is cash sale, that means you have received the money immediately, then only you will record it in your business transaction. But we all know that it is not possible every time. Every business, they used to make credit sales or credit purchase as well. In that case, you don't make cash payment or you don't receive the cash immediately. So in accrual concept, they say that if a particular transaction is related with your business financial period, say this year 2020, okay, you have made one credit sale this year, then you will record it in your financial statement. You will not wait for cash to receive. Suppose if you receive the amount next year, then cash basis says that you have to record it in next year, but accrual basis says that since the transaction took place in 2020, you have to record it in this year's financial statement and not on cash not on next year's accounting statement. Then these were the three important accounting concepts. First one was going concern concept, second one was, what was second one? Consistency concept, and third one was accrual concept. Now there are other concepts as well. Now let us see business entity concept. Now according to this concept, business is treated separate from the owners or creditors. When you start a business, it is you who invest money or any other capital, goods or all, to start a business. So you cannot say that you are the business. Your business entity will be treated separate from you, and because of this business entity concept, even though you are owner of the business, you will be treated as creditor of the business, because you are the one who is giving business a particular amount of money as capital, and that business that has to repay back that capital amount. Now business unit should have a completely separate set of books, and we have to record business transaction from firm's point of view and not from the point of view of the proprietor. Now because of this business entity concept, all the transactions should be recorded from business's point of view and not from owner's point of view. Proprietor is treated as creditor of the business till the amount which he has initially invested as capital in the business. That is why capital is nothing but a liability for the business, which over the time it has to pay back to the owner. Then it is for this reason that we also allow interest on capital. Means every year business, it has to pay some amount of interest on the capital to the owner and treat it as an expense of the business. Now the amount of interest that the business pay to the owner, it is treated as nothing but expense of the business. Now as we all know that interest on capital, since it is an expense, it will reduce the profit of the firm, and at the same time it increases the capital of the proprietor, because since proprietor is receiving that amount, it is increasing his capital amount. And in a similar manner, the amount which proprietor withdraws from business for his own personal use will be treated as drawings, and on those drawings also the proprietor has to pay some amount of interest to the business, and that will be nothing but income for the business. It is not only money that he can withdraw from the business, he can withdraw goods also from the stock for his own personal use, and in that case that withdrawing of goods or cash will be treated as expenditure for the business. Now because of the concept of separate entity, the proprietor's house, his personal investment in securities, his personal car, and personal income and expenditure are kept separate from the accounts of the business entity. Means these are all his personal property, not related with the business. That's why all the things are treated different or separate from business entity. Now from this concept, only thing you have to remember is that business is treated separate or distinct from that of owner or any other parties. Okay. Then next is money measurement concept. In chapter 1 we have discussed that all those transactions which can be converted or which can be expressed in money will be recorded in accounting statements. Now this is money measure concept is nothing but that feature only those transactions and events are recorded in accounting which are capable of being expressed in terms of money. If an event, no matter how much important is that, if you cannot express it in terms of money, you cannot enter it in your financial statements. Now there is one example given as well. Accounting does not record a quarrel between the production manager and sales manager. It does not report a strike is beginning, and it does not reveal that a competitor has placed a better product in the market. Now these are all related with business, but since we cannot express it in terms of money, we will not record these things in our financial statement. Now next is accounting period concept. Now in business going concern concept, we saw that business is going to exist for a long period of time, but to exactly know how much amount of profit or loss a business have suffered, we can calculate that after the business has been winded up, but it is not possible for us to know exactly at what time and when the business will be wounded up. So in order to find profit or loss for a particular period, its lifetime is divided into small pieces of time, and that is nothing but accounting period. Okay, as we all know that calendar year starts from 1st January and ends on 31st December of every year, but in accounting you have to remember that we go according to the income tax law, and this income tax law says that we have to adopt financial year that will begin from 1st April of every year, and that it will end on 31st March of next year. Suppose now it's October 2020. Now today's date's financial year will be it has started from 1st April 2020 and it will end on 31st March 2021. Then next is cost concept or historical cost concept. Now according to this concept, it is said that according to this concept, an asset is ordinarily recorded in the books of accounts at the price at which it was acquired. Means the amount at which you have purchased that asset only that amount you can record. It doesn't matter how much market value of that asset is now. Okay, suppose 5 years back you have purchased a piece of land for 1 lakh rupees, and now its value has been increased to 5 lakh rupees. Even though the market value is 5 lakh, you cannot mention 5 lakh in your balance sheet or financial statement. The amount that you have purchased, that is 1 lakh, that 1 lakh amount you can record it in your financial statements. Then next concept is dual aspect concept. Now according to this concept, they said that each and every transaction or event, it affects minimum 2 accounts. That is why it is also known as double entry system. It says that for every if one account is debited, another account must be credited. This rule we will see in subsequent sessions, but for time being you remember that for every transaction at least 2 accounts will be affected. Suppose if one is increasing, another will be decreasing. Now earlier we saw a formula that assets is equal to liabilities plus capital, or capital is equal to assets minus liabilities. Now these are nothing but 2 sides of balance sheet. This part will be debit side of balance sheet, and this side will be credit side of balance sheet. Now after each and every transaction, both the sides should be equal. That is the rule of dual aspect concept. Means if one of the assets is increasing, another liabilities or capital will increase, or either one asset will increase, another asset will decrease. Then let's understand clearly with the help of an example. X commences business with 20 lakh in cash and takes a loan of rupees 5 lakh from bank. Now 20 lakh is his capital and 5 lakh is his liabilities that he took from bank as loan. Now these 25 lakh are used in buying some assets. Means all those 25 lakhs he spent it on buying some assets. Now asset, we know that it's on another side of balance sheet. So after this transaction, after this purchase of asset like plant, machinery and all, what we have is that asset he have worth rupees 25 lakh, and he took liability 5 lakh and capital of 20 lakh. Now see, both the sides are equal. So for every, you just have to remember that is for every transaction minimum 2 accounts will be affected. If one is increasing, another will decrease. Okay, now revenue recognition or realization concept. Revenue, we know that nothing but the amount that we receive as a result of day-to-day business operations. Now revenue is earned by sale of goods or by providing a service. Concept of revenue recognition determines the time or the particular period in which the revenue is realized. Revenue is deemed to be realized when the title or the ownership of the goods has been transferred. Now according to this concept, we will consider revenue, we will consider the revenue took place on the date or on the moment when the ownership of goods has been transferred. Now it will be easy for you to understand with the help of an example. Now see, suppose if a firm gets an order of goods on 1st January, they received an order from one of their client that they have to sell some goods on 1st January. Means they received order on 1st January, but they made supply on 20th January and received cash on 1st April. Now according to revenue recognition or realization concept, we will take 20th January as the date of transaction, because on this 20th of January the owner, they have supplied the goods to the buyer. Okay, that is why 20th January will be considered as the revenue recognition date, or the date on which the transaction took place. Now revenue in case of income such as rent, interest, commission, etc. is recognized on a time basis. Rent for the month of March 2015, even if received in April 2015, that means it is received on the next financial year, that is April 2015, but still it will be treated as a revenue of March 2015 because it became due on that particular date, not on April 2015. Similarly, if commission for April 2015 is received in advance in March 2015, we were supposed to receive on April 2015, but we received it in advance on March 2015, so it will be treated as commission for accounting year April 2015, not for March 2015. Then next is matching concept. Matching concept is nothing but it is another version or same as accrual basis. This concept is very important for correct determination of net profit. According to this concept, in determining the net profit from business operation, all costs which are applicable to revenue of the period should be charged against that revenue. Now, according to this concept, it means that all the operation or the transaction or all the costs which are related with one particular year, financial year, will be treated as transaction of that particular period. It doesn't matter whether you have received the money or not. For example, you were supposed to pay rent of March 2020, okay, but you paid it on May 2020 because you paid the amount on next financial year, but still it will be treated or it will be recorded in the transactions of the financial year 1920, that is March 2020. It doesn't depend when you have received the money. As soon as it becomes due, it will be recorded in the financial statements. These all things you will understand clearly when we will start preparing financial statements. The next is objectivity concept. This concept requires that accounting transactions should be recorded in an objective manner, free from the personal bias of either management or the accountant who prepares the accounts. It is possible only when each transaction is supported by verifiable documents and vouchers such as cash memos, invoices, etc. Now, according to objectivity concept, it means your business transactions, recording of business transactions or preparation of financial statements should be free from your own personal biasness or your personal judgment, and it will be possible only if you have particular proof of each and every transaction. Until unless you don't have any proof or verifiable documents, you cannot make entry into the books of accounts. So objectivity means you should not be biased towards your business. You should have proper documents or proper proof for each and every transaction. Now, next is accounting conventions. Accounting convention may be defined as a custom or generally accepted practice which is adopted either by general agreement or common consent among accountants. Now, these accounting conventions, they are not concepts that we have to follow. These are only generally accepted practice, means facts that all the accountants they use. Okay, so it doesn't depend upon, it is not compulsory to follow each and every convention, but accounting concepts are very important, they have to follow. So first let us see what are accounting conventions, and then we will make a comparison between accounting concepts and accounting conventions. Now, there are three accounting convention. One is convention of full disclosure, second is materiality, and third one is conservatism or prudence. Now, first let us see what is a convention of full disclosure. Now, according to this convention, it says that all the information relating to economic affairs of the enterprise should be completely disclosed. Means you have to show all the information of your business to the interested parties. In other words, there should be a sufficient disclosure of information which is of material interest to the users of the financial statements, such as proprietors, present and potential creditors, investors, and others. Means all those parties who are interested in your business, and if they want to see any of your statements, then it is your duty or it is your responsibility to show them all the information. You should not hide anything. Okay, Now because of this only, the Companies Act, they have provided pro forma or contents of balance sheet and profit and loss account, because Companies Act, whatever they want to know about your business, whatever items or whatever particular information they want to know, through that pro forma and contents of balance sheet and profit and loss account, they will know, because you have to prepare your balance sheet and profit and loss account according to the format or pro forma given by Companies Act. Now next is convention of materiality. Now this convention is opposite of full disclosure. In full disclosure, we saw that every information should be provided to the interested parties, but convention of materiality means that whatever information which is not important to anyone, you should not show it to anyone else. Means you have to keep something secret until and unless anyone asks about that particular information. You don't have to show it to anybody. Okay, now one more fact about point number 1, convention of full disclosure, is that disclosure of material facts does not mean leaking out the secrets of the business, but disclosing sufficient information which is material interest to the users of financial statement. It doesn't mean that you have to show everything, including your secret of your business. No, it doesn't mean that. Only those information which are required by a particular party or person, only those things you have to show. And convention of materiality means you don't have to show what is not asked by anyone. Then last convention is convention of conservatism or prudence. Now according to this convention, all anticipated loss, means expected loss, should be recorded, and all expected or unearned gains, we haven't received the gains yet, should be ignored. Means you have to show more losses than your profit. Okay, this is what is meant by this convention of conservatism or prudence. Means you are conserving your business against all those possible losses. Now because of this convention only, your profit and loss account will show more loss and less profit. Okay, so it is providing a protection to your business against uncertain or unexpected losses. Now there are some examples of this conservatism. Closing stock is valued at cost price or realizable value, whichever is less, means the price at which you have purchased, or the market value, whichever is less, you will have to record it in your books. Provision for doubtful debts, means debts which have become doubtful, means you are not sure whether you will be receiving that debt amount or not. So for that you have to make provision, means you certain amount of money, certain account you have to make for that particular doubtful debts. Then joint life insurance policy is shown at surrender value as against the amount paid. Provision for a pending lawsuit against the firm which may either be decided in his favor. These are not that much important. Only thing you have to remember is that in convention of conservatism or prudence, all the anticipated losses are recorded in books of accounts, and all anticipated or unrealized gains should be ignored. Now there are some effects of this convention. Profit and loss account will disclose lower profits in comparison to the actual profit, because you are including more losses than your profit. That is why profit and loss account will show lower profit. Then balance sheet will disclose understatement of assets and overstatement of liabilities. Means in balance sheet you will be showing value of your assets less than the actual amount, and the liabilities will be shown at a much higher value than normal or actual values. Okay, now these were accounting concepts and convention. Now let us see what are the difference between these two. When we talk about legal position, accounting concepts, they have legal acceptance, means they are made mandatory by the legal system. But accounting convention, these are only guidelines or custom, like something that comes in natural. Okay, like when we talk about religious customs and all, it is not legal, but it is something that we saw from our ancestors and we are following. Accounting convention is also like those customs only which are followed in while preparing financial statements. Now, recording versus financial statements. Account concepts are the basic assumptions on the basis of which transactions are recorded and accounts are maintained. Now, accounting concepts are the basic things that we have to keep in mind while recording the business transactions. But accounting conventions are followed in preparing profit and loss account and balance sheet. But these conventions are rules which we have to follow. Then, significance. These are uniform set of rules usually followed in recording the transactions. Now, these are the rules that we have to follow. Okay, we cannot accept these accounting concepts, but accounting conventions, they are not that much compulsory to follow. It is up to us whether we want to accept them or not, whether we want to follow them or not. Now, role of personnel. There is no role of personal judgment or individual bias in following the accounting concepts. Means we have to follow them. We cannot say no, we don't want to follow these accounting concepts in our business. But accounting conventions, they play a crucial role. Means it depends upon us whether we want to follow accounting conventions or not. Means for accounting convention, point number one, like disclosure. One, convention of full disclosure. It is up to us whether we want to show any information or not. It depends upon us whether we want to show it or we want to keep it as secret. Suppose if third party wants to know a particular information about your business, then you can say no to them also. You can say that the information that you want, it is secret of our business and we don't want to disclose it to you. So accounting conventions, it depends upon our own judgment whether we want to adopt it or not. Then uniform adoption. Accounting concepts, they are uniformly adopted in every enterprises, but for accounting conventions accounting conventions, it is not mandatory for all the enterprises to adopt. Okay, so these were accounting concepts and conventions, and I hope you have understood this chapter. And if not, then you can contact me, and in our next session we will start a new chapter. Thank you.